This week, we'd like to discuss 3 key messages. The first is what's happened in equity markets over the last week. Secondly, macroeconomic data. And thirdly, a question of when clients should invest their cash in their portfolios. Message 1, market update. After 8 to 10 weeks of relatively strong equity market performance, we've seen some pullback this week. In the US, the S&P 500 is down about 1%. European markets are down between 3 and 5%, and the Hang Seng Index in Hong Kong is down nearly 5%. The reasons for the soft patch in equity markets has been some weaker economic data and also some mixed corporate results. Message 2, macroeconomic data. So we've seen a variety of macroeconomic data out this week, which is consistent with slowing growth, but is still also consistent with our view that economies will continue to grow, particularly the US economy this year. In particular, we've had purchasing manager indices numbers for the UK, for China, and for the US. These indicate that both the UK and China growth is starting to contract, whereas in the US, this number is still above 50, which is consistent with our expectation of growth in the US economy. Message 3, invest in cash. Last week, we mentioned that we'd raised cash in clients' portfolios. This has led to the question for those clients who are seeking to invest new cash in the market, whether now is a good time to put that money in. Generally, when we receive cash in portfolios for clients, we are patient, longer-term investors, so we don't put all the cash to work immediately. We generally take 3 months to invest the cash, and that enables us to take advantage of falls in the market over that 3-month period.